Hello, everyone, and welcome to Karora Resources Live Summit today, hosted by SIX. We're joined today by Oliver Turner, their Executive Vice President of Corporate Development. Oliver's going to walk us through a company presentation, and after we will move on to a live Q&A. So as a reminder, you can submit your questions at any time on the right-hand side of the screen, and we'll try to get to them after the presentation. And as always, the summit is recorded and will be available to watch afterwards on six.com. But without any further ado, I'll hand it over to you, Oliver, to kick things off.
Yeah, thank you very much, and hello everyone. Happy to be back here with SIX again to provide you with an update, and I'll keep it balanced. We'll certainly update everybody who is well up to speed in the story and some of our exploration initiatives this year, as well as our operational outlook, and then also make sure for those of you who are new to the story to provide a little context and background to help bring you up to speed. So let's get into it. So Karora Resources our assets are located in Western Australia. We have three primary mines or collections of mines, I should say, in Western Australia in the Kalgoorlie Belt. The Kalgoorlie Belt is the most prospective belt in all of Australia and has produced the most gold of any region in the country. And we are very proud owners of the largest land package, or the largest covering, which is 1,900 square kilometers of that area. So the Kalgoorlie Belt runs all the way from the Kalgoorlie Super Pit up here to the north, down through our property, and passes down to Norseman and near our Mount Henry deposit. Our three operations are the Beta Hunt underground mine, the SPARGOS high-grade open pit mine, which we've recently started mining, as well as our Higginsville Central collection of open pit mines and our mill in the middle there. All of those deposits are feeding that centralized mill, which is currently operating at 1.6 million tons per annum. And we are well on our way towards building our production level from approximately 120,000 ounces this year, if you choose the midpoint of our guidance, to 200,000 ounces by 2024. All of this gold production is self-financed. You'll hear me say that a couple times over the course of this presentation, between our operational cash flows and our liquidity, available liquidity, I should say. And we also have a very aggressive exploration program in that area right across the property that I'll be updating you on today. So stepping into the management of the company, for those of you that are new to the story, we are led by Paul Hewitt, who was the former chairman and CEO of Klondex Mines. He took that from shortly after inception all the way through to an eventual sale to Hecla Mining. A very similar story to what we've been building here at Karora over the past couple of years since Paul joined in late 2018 into early 2019. And that's a hub and spoke model. So he took Klondex Mines from a single asset that was toll milling all the way through to a multi-mine company feeding a centralized mill. Very similar to what we've done at Karora, where originally the company only had the Beta Hunt underground mine that was toll milling, and in mid-2019 added the Higginsville mine and mill, and fed both Beta Hunt and Higginsville into that mill. And then in 2020, we acquired the SPARGOS open pit mine, which is also feeding it today. So that hub and spoke model has been done before, and the track record of success from Klondex is certainly parlayed well into Karora. Graham Sloan, the gentleman on the right, is our Managing Director of Australian Operations. He's been the spearhead of the operational turnaround that we experienced over the last couple of years at Karora. He's the former CEO of Perseverance Corporation and was the gentleman behind the construction of the Fosterville mine. Certainly a mine that has worldwide recognition, and Kirkland Lake, of course, now Agnico, has been enjoying the success of that operation for a long time. So Graham has a very strong technical following in Australia. When he came into the story in early 2019, he brought a wave of new technical talent with him, which have led the charge with respect to the operational turnaround. So very fortunate to have both of them leading the charge for us at Karora, and both are based in Perth, Australia, where our head office is. Rounding out the team at Karora is myself, the Executive Vice President of Corporate Development. Prior career was spent at GMP Securities as an equity research analyst, and prior to that as a mining engineer at Wardrop Engineering. Barry Dahl and Michael Doolin are both ex-Klondex as well. Barry Dahl is our CFO. He's also the ex-CFO of Argonaut Gold. And Mike Doolin was the former Chief Operating Officer of Klondex and also has other C-suite experience and is leading our technical charge here as well. So a lot of the team that has done this before is doing this again and has done this again at Karora. With respect to ESG, if you were listening to our conference call Monday morning, we did announce that we've been taking ESG very seriously. And in fact, we're going to be updating the market with our inaugural ESG report by the end of this quarter, which is a huge milestone for Karora and something that we're very proud to have accomplished. It's been about 18 months of hard work to get that to the place where it is today. A lot of discussions and work with stakeholders as well as external experts in order to compile that document. It's a very substantial document that'll be updating the market on our entire ESG strategy. A very strong component, or important component of that, I should say, is our net zero initiative here, which is to lead the charge on decarbonization of the mining industry. We made a strong statement middle of last year via our partnership with the Net Zero Company, and then followed that up in the fall with a strategic investment into an Australian afforestation project. This is going to work hand in hand with an emissions reduction strategy, a medium and long-term strategy, which we are currently developing with the Net Zero Company, which will include evaluation of a number of different initiatives, including alternative power generation, the evaluation eventually at future fleet replacement cycle times of potential use of electric vehicles, biodiesels, a whole range of options that we have that may or may not be cost positive now. If not today, they will be a little bit later on. That'll be leading the charge on our emissions reduction strategy that works hand in hand with that investment I previously made. We're very happy to invest in the Mount Sandy Conservation Project. We all remember the bushfires of 2019. Those of you that have seen me on a call before have heard me say this before. We're proud to be part of reforestation and protection of biodiversity in Australia, especially when it's on Indigenous land and employing Indigenous people. So really congruent with our initiatives at Karora, and you'll get more updates on that in our ESG report. Stepping into the track record of production before we start looking forward into 2022 and really talking about exploration. Since we acquired the Higginsville mill in mid-2019 for $50 million from Westgold, we have delivered consistently on the operational front, both with respect to production at 25,000 ounces a quarter initially, now of course ramping up as we build into our growth plan, but also with respect to the reduction in our all-in sustaining costs. Initially, this company was around the $1,300 an ounce mark in all-in sustaining costs, and we stated in late 2019, early 2020, that we had a target of getting to that 1,000-ounce mark. Very happy to say that despite the continued ongoing challenges in Western Australia with COVID restrictions and the impact it's had on the entire sector, we have hit that target, and we reported this morning a 2021 all-in sustaining cost number of $1,012, despite those increased cost pressures, which was fantastic. On an ounce perspective, we met the top end of our guidance for 2021, just under 113,000 ounces, which we were very happy to achieve. Looking forward, we have this slogan called the path to 200. We are building to a 200,000 ounce a year producer from our base of about 120,000 ounces, if you pick the midpoint, as I said today. But also you'll notice the decline or decrease in all-in sustaining costs as we get up to that 200,000 ounce a year mark. And that's going to come from several different areas. But what'll be good here is just to step into a couple of the numbers in some more detail with our production and cost guidance here. We did recalibrate our numbers for 2022 about a month ago. What we did was we widened the range and we lowered the top end of guidance by about 5,000 ounces, and we had a 12% increase in our all-in sustaining cost numbers and capital numbers. For those of you new to this story, this was a very prudent move that we made in order to capture the ongoing pressures, of course, of COVID-19 restrictions in Australia and supply chain impacts. And we went out and talked to our top vendors at Karora and tried to get quotes for them for this year and to get a sense of what inflationary pressures they were experiencing. The responses we got showed anywhere from about 7% through to 15% of impact on input costs. So we increased our numbers by about 12% for this year. All of this is, of course, within the original guided range. And we wanted to put numbers out to the market that really level set expectations in the reality of the current operating environment. And we're very comfortable with these numbers moving forward. Of course, when you make these moves within, I guess it's Murphy's Law, within a couple of days, things go the other way. So we're very happy to announce that as of March 3rd, the Western Australian state borders are open for the first time in 627 days. That number is real. And you no longer have to quarantine on either side of the border. So what we are expecting is some alleviation, particularly in the labor market. It's been a very tight labor market in Western Australia for talented and technical labor, as about 40% of the workforce that works in Australia in the mining industry comes from out of state. So as this border is opened up and is more realistic for people to fly back into work, remember that Kalgoorlie is a fly-in, fly-out, predominantly a fly-in and fly-out camp area. We expect some of those labor pressures to somewhat alleviate. Now, of course, it's not going to happen overnight. This will take time. And Australia, with respect to COVID-19, is, in particularly Western Australia, isn't a particularly challenged moment right now. But as we know with the rest of the world, they will get through that, and we'd expect some alleviation there. So stay tuned there. One other area I do want to highlight here is that for the first time ever under Karora, we included a nickel guidance this year. So we included guidance of about 450 to 550 payable nickel tons. And that's going to come predominantly from, or entirely, I should say, from remnant nickel mining at Beta Hunt. As we all know, or for those of you that are up to speed on the story, there's some very exciting new nickel potential, which I'll talk about in a few slides here at Beta Hunt. But very importantly, this was done at our budgeted cost, which in today's nickel environment looks very conservative, of $16,000 per ton. So there's significant movement or room for additional byproduct credits as we step into mining those areas at higher metal prices, and then of course expanding nickel production in future years. Last bit on this slide here is we have not changed our 2023 and 2024 numbers. We're very comfortable with those. Hopefully we're not sitting here a year from now in the same COVID-19 constrained environment, but we're very comfortable with those. We have a healthy buffer built in, and we're on track to deliver. With respect to the growth plan itself, it's going to come from two areas, and this is for people that are new to the story. It's going to come from the addition of a second decline at Beta Hunt and the expansion of our mill to 2.5 million tons per annum from 1.6 million tons per annum today. That is going to be driving the growth almost entirely from Beta Hunt. So Beta Hunt is approximately 70 to 80,000 ounces per annum currently. That's going to increase to about 150,000 ounces per annum by 2024, with the remainder of that production profile to 200,000 ounces to be filled by Spargos and our Higginsville properties. With respect to Beta Hunt, let's step into it because it is the backbone of the operation. The expansion that we're going to be going through is going to be pushing Beta Hunt from 1 million tons per annum to 2 million tons per annum per year. That's a terrible two, I apologize. The mill is going to be expanded to 2.5 million tons per annum. So you're going to have approximately 80% of your tonnage coming from Beta Hunt, and actually coincidentally about 80% of your ounces. So it really is the valuation backbone of the company for the foreseeable future. We have a substantial gold resource, and we also have a remnant nickel resource at Beta Hunt. We are going to be updating both of those resources this year. The first one will be the gold resource that we'll be updating around about the end of the quarter here on the gold side of things. Some very interesting new zones that will be included there. And the nickel resource will be updated by mid-year as well, with the inclusion of a new zone we call the 50C, which I'll outline for you in a few slides here. With respect to the advantage that we have at Beta Hunt, so one of the key components of the low-cost operating environment of Beta Hunt is the fact that for 40 years prior to it being a gold operation, it was a nickel operation. How is that a benefit to us? It's a benefit to us because we have over 400 kilometers of existing development already in place at Beta Hunt that we get to leverage for mining of gold and now increased nickel. That is a huge advantage and saves us a tremendous amount of development costs, as well as the ground conditions we're operating in are superb. We're mining, and our development is in a very competent basalt unit. What does that mean? It means our ground support requirements are minimal, and we in fact do not have any backfill requirements. For those of you that have looked at long hole stoping operations in North America, as I did for a significant amount of time as during my analyst career, the costs associated with backfill there were substantial. The costs associated with mining at Beta Hunt are substantially less, which means we enjoy significant margins even at that grade of 2.7 grams per ton. I should mention that the grade of 2.7 grams per ton does not allow any influence from coarse gold intercepts, which we do encounter at Beta Hunt. There's a lot of history there for those of you that remember the RNC days, but we make sure that doesn't influence resource grades or our mine plan. So we really do generate significant cash flows at the average grade. One other area I do want to highlight on this slide is the green block here, which we'll talk about in a couple slides, the LARKIN zone. The LARKIN zone is going to be included for the first time ever in our 2021 updated resource, just coming out in several weeks here. So stay tuned for that. We took it from inception through to resource category in record time. I mentioned the expansion of Beta Hunt via the addition of a second decline. The expansion will take us to that 2 million ton per annum mark, and it's going to be through the addition of a second decline, which is really leveraging the success of what we've already done already. Our existing decline on the other side of the ore body is producing about 1 million tons per annum, and our operational team led by Graham Sloan has done a fantastic job in improving our operational efficiencies in that ramp. And what we're doing here is basically duplicating that with the addition of a second decline. Very happy to update everyone here that progress is already underway. We've begun the second decline from underground with our own operational crews. We've also begun the earthworks associated with the sinking the decline from surface with contractors. We started that on February 14th. So work is being attacked from both directions there. They will meet in the middle. The budget for the second decline, as we outlined middle of last year, is $45 million Australian. We are very comfortable with that number, and that remains on track and on schedule. One of the advantages that we have at Beta Hunt is that we get to expand our resources in multiple directions. We're expanding down plunge, we're expanding western flanks and A zone up plunge at the same time. And a very interesting area that we have been drilling is from surface, where the second decline will be going. And let's zoom into that on this next slide here. So here we have western flanks and A zone, and we've been expanding these from underground to the north, and you'll be seeing some of the fruits of that labor in our resource update here in several weeks. But we've also been drilling from surface to test this area and see if there's any potential mineralization there. Now, late last year, we did update the market. We hit a major structure there. It was about a 40-meter wide structure, which proved our thesis that shear zone that hosts the western flanks and A zone potentially continues all the way up to surface. We will continue drill testing that from underground, as it is cheaper to drill from underground as this second decline progresses. But what's quite interesting there is that if we're able to mine some ore there as we sink that second decline, that is outside of the numbers that we put out associated with our growth plan. So could offset some of the capital costs associated with that decline. Certainly an interesting source of upside, and could potentially signify a major extension of western flanks and A zone to the north, which of course equals more gold ounces. A planned view of Beta Hunt here, no shortage of targets for us to be drilling. As I said, our entire resource is hosted at western flanks and A zone right here. We're expanding them from underground to the north right there. Fletcher is in a very interesting area that we've got many drill holes into, and we will be expanding. East Alpha is an area where we have more nickel potential. Larkin is the area I mentioned earlier, which we took from initial discovery in late 2020 through to inclusion in our resource estimate just coming in a couple of weeks here. And then, of course, a very interesting area which we'll be focusing on today is the Gamma block, which includes gold and nickel in very exciting grades for sure. Stepping into the Larkin zone, just to give some context for those of you new to the story, the Larkin zone was discovered in a way that we've discovered a lot of things at Beta Hunt, and that is utilizing existing infrastructure. So when we eliminated some very significant royalties and wound back some very significant royalties that we have at Beta Hunt in 2020, we got our drills turning from underground. But first, what we did was channel sample the walls of the existing underground development. So this drift that you see in place here has been in place for about 20 years in that very competent basalt unit that I talked about. We channel sampled the wall. We found 14 meters of 5 grams per ton, knew that we were on to potentially a new shear zone, threw a drill in the drift, drilled through the back, through this gold zone here, which was fantastic, and then kept drilling until we hit that basalt ultramafic contact, where we hit the 30C nickel trough, which was a brand new nickel discovery at Beta Hunt. So we got, with one drill hole, the discovery of a new gold zone in the Larkin zone and a 30C nickel trough, 2 for 1 really, which is a common theme that we have at Karora. That 30C nickel trough will form part of an updated nickel resource coming before the middle of the year, and that gold zone will form part of the updated gold resource that will come in the next several weeks here. In just about a year and a half since discovery, we've drilled the Larkin over 1 kilometer in strike and 150 meters in vertical extent. That is a substantial advantage that we have at Beta Hunt is really leveraging that existing infrastructure that would have taken us substantially longer and cost us substantially more had we not had that development in place. So we're very fortunate to have it, and we are leveraging it right across the operation. Let's step into that gamma block. I talked about it before. This is a big area of focus for us now, both with respect to gold and with respect to nickel. We announced the discovery of gamma block, or the discovery hole, which is a fantastic hole, 4.6 meters of 11 grams, or 11% per ton, I should say, in April of last year. Since then, we've been aggressively drilling out that area from existing underground development, and we started to develop a very significant nickel block. The nickel block is about 200 meters by 120 meters and growing. And one of the most interesting things that we have with respect to our thesis here at the gamma block is when we start talking about these fault lines. So we currently have the Gamma Island fault here. And the way that these gold zones work and nickel zones work at Beta Hunt is you have these zones that are very continuous. They hit a fault zone, they're fault offset, and then they're very continuous again until they hit another fault zone, and then they're fault offset. Sometimes they're lifted a little bit higher, and in the case of 50C, it is actually lifted a little bit higher, which is very good when it comes to cost of mining, because obviously cost of mining increases as you go down at depth. So that 50C area that we've discovered on the other side of the Gamma Island fault has a very interesting growth potential. We have 2.6 kilometers to our property boundary here, and I understand this slide's getting a little bit messy, but it is always easier if you draw. 2.6 kilometers to the property boundary, which, given the continuity of other nickel troughs that we see in the mine, has the potential to extend the 50C for that distance. Now, we're not saying that it does, but we're saying it has the potential to. Of course, we're going to have to prove this with drilling. One of the best supporting theses we have for that continuation is a historical drill hole that's located 1 kilometer away from the current area that we're drilling that had 9.5 meters of 11% nickel. Certainly a very exciting nickel intercept and a good supporting component for the expansion of that zone. So we will continue to drill out that zone, and it is part of our 2020 budget in terms of drilling. About $2 million of our 2020 budget, which in total is about $20 million, will be going towards the 50C. So a lot of drilling to be happening there. And as I mentioned, the 50C, the 10C, and the 30C will all be included in that updated nickel resource. When we look at it in section, I talked about it being 120 meters wide. It is a wide zone, which is fantastic for bulk mining applications. But also, we have, as is very similar with a lot of the areas in Beta Hunt, a gold zone that we've intercepted underneath it. In fact, we intercepted a 40-gram intercept over there in the Gamma block just a while ago, which we'll be following up on. So it looks like from existing underground development, obviously we're going to have to develop over there to mine it. We'll be able to mine both gold and nickel from the same infrastructure, which is the common theme at Beta Hunt. So certainly a very exciting economic driver for the company. And in the entire company's focus, this gamma block is turning into the place where we could potentially return the most significant dollars for each dollar that's invested. So it is a priority of ours, and we will be working aggressively on this year in order to advance it towards production. With respect to other zones, we've got lots of interesting exploration right across the operation. We have some very substantial drill holes at A Zone and Western Flanks North. I mentioned that 40-gram over 4-meter intercept at the Gamma block. We also intersected the widest intercept to date just west of the Larkin zone. It was 1.5 grams over 90 meters, which was a fantastic intercept. So lots going on at Beta Hunt. And with respect to drilling and drilling budget, how are we spending our dollars? So we have a $20 million budget that we're spending this year. We spent $20 million last year, and we're going to be spending $20 million over the next 2 years. That is the largest exploration budget that this region has seen in well over 10 years. And we've obviously returned significant success with that. Now, those drilling budgets are split between several categories of drilling. We have exploration drilling and res def drilling, and of course, grade control drilling, which goes into our operating budget. Those drill holes are split at Beta Hunt basically as follows. So for exploration at Beta Hunt, we're going to be drilling about 20,000 meters, or about $5.5 million Australian is going into exploration. Resource definition will be about another 20,000 meters. The holes tend to be a little bit shorter, so we're going to be spending about $4 to $4.5 million there. And the remainder of that budget will be spent at Higginsville. I'll talk about that when we get there. So suffice to say that a lot of drilling is going into there. One of our priorities for underground exploration drilling on top of the Gamma block at Beta Hunt is the A Zone North extension, where we're going to be drilling about 2,500 meters. Now, everybody that's been watching my presentations and our presentations over the last year or so has known that we keep talking about assay turnaround times. Drilling is not the challenge at Karora. We certainly have a lot of drills turning. We spend a lot of money on drilling, and we've had fantastic success from drilling. The bottleneck has been assay turnaround times. Now, we've managed to address that in several ways. Number one, we built an assay lab on site. And what you can do is internal grade control assaying at your own lab. For exploration results, it must be done by a third party off-site. So those drill holes and those samples still have to go up to Kalgoorlie to be sampled at a very, very busy assay lab that, due to COVID, has been understaffed for about a year and a half. That has led to exploration assay turnaround times and resource definition assay turnaround times of about 7 to 9 weeks, which is obviously quite frustrating, but everybody in the industry is experiencing it. And when we do get those assays back, we get enough of them back to build up a story, and then we release it to the market. So that's really why the sort of turnover time between drilling and releasing the results to the market has lagged behind normal timeframes. Hopefully, with the borders opening up, as I previously mentioned, we start to see some of those timelines compress back to more normal and better timelines for us to release news to the market. But as we mentioned, it won't be overnight. It's going to take the course of this year for things to return to normalcy. With respect to Higginsville, let's talk about Higginsville, which is an enormous property, 1,900 square kilometers that we own, 1,800 square kilometers that approximately is the Higginsville tenements. That is the largest coverage, even more so than the senior gold producers in the regions, the largest coverage out of anybody on the Kalgoorlie belt, which is a pretty enviable place to be as a junior producer with aspirations to grow into a mid-tier producer. So suffice to say, we have a lot of targets to drill at Higginsville. The Higginsville resource inventory is also quite significant. We split it into two areas in late 2020 when we put out our last resource update, Higginsville Central and Higginsville Greater. Higginsville Central is the area immediately around the mill and is our high-grade immediate source, or near-term source, I should say, for mining. Higginsville Greater encompasses the wider area and has a very large inventory as well. A lot of that is held captive down at Mount Henry, which is an interesting property. You've got about 1 million ounces there as well, and we're certainly running some evaluations on what that could mean. But let's focus on Higginsville Central, and then one particular area I want to update the audience on today called the Sleuth Trend. So Higginsville Central here, these are several deposits that we have. We're currently mining 2 open pits in Hidden Secret and Mouse Hollow, which have been performing very well for us. We also have 1 new underground operation called Aquarius and a restart of a past producing operation called Two Boys, which we are currently mining both of them today. Aquarius, we have our ramp right down to the top of the ore body. We're going to be accessing the middle of it in the coming weeks, and then we'll be able to start extracting ore beyond just development ore. We'll be into stopes there. And Two Boys, we're also into some development ore there as well, and that'll be feeding the mill. Both of them will be improving some of the grades at Higginsville. But remember, as we expand our operation, 2 million tons per annum of that 2.5 is coming from Beta Hunt. So that leaves approximately 0.5 million tons per annum for Higginsville and for SPARGOS. So both those assets are going to be competing for that 500,000 tons per year. And as you'll see on the next few slides, SPARGOS is certainly making a strong case for displacing more and more of that Higginsville ore. Nevertheless, all of these ore sources are needed for blending and to ensure we maintain our high recoveries north of that 92-93% mark. So let's step into what I consider to be one of the most exciting exploration targets that we have at Karora, and that's called the Sleuth Trend at Higginsville. So just take a step back before we jump into some of the details here. So I mentioned our exploration program at Beta Hunt. At Higginsville, we are also going to be spending or drilling about 20,000 meters of true exploration, round about the same cost of Australian $5 million. The focus of that is going to be SPARGOS, where we're drilling north of 4,000 meters, and then also this Lake Cowan area and Sleuth Trend, where we have a strong exploration focus. On top of that, we'll be doing about 20,000 meters of resource definition drilling, and then of course, lots of grade control, which goes into that mine operating budget. So let's take a step into the sleuth trend here at Higginsville, which is a very, very interesting target, which has a lot of the hallmarks of potentially being a successful target. So the sleuth trend sits right next to the major regional Saluka shear. So the Saluka shear runs all the way from the Kalgoorlie Super Pit up here, down underneath our property, past our property, and down to Pantoro down here. Now the Super Pit area is north of 30 million ounces. Apologize for the writing. And 6 million ounces down at Pantoro. So it is host to very, very large deposits. There's also the St. Ives area, which has a 14 million ounces right next to Beta Hunt. So this primary regional shear zone is what hosts a lot of the large deposits in this region in Kalgoorlie. So you've got major regional structure. We also have a past producing, and currently we are looking at actually taking the last few ounces out of Baloo, open pit. The old Monsoon target, where S2 Resources drilled 66 meters of 11 grams per ton. And so when we realized all of this lined up in this 5-kilometer trend between the two of them, we said we should probably step in and do some geophysical work here. So in 2020, we ran a very large geophysical survey, 400 square kilometers of that 1,800 square kilometers that we have. And we returned some very interesting results. We had a very large anomaly that was in this area. And so what we did was we stepped in with air core drilling. For those of you not familiar with air core drilling, it's a reconnaissance drilling method. What you basically do is you drill small vertical holes that are about 100 meters vertically, and you basically drill to refusal. It's the definition of quantity over quality. You're trying to cover a large area. It's very commonly used in Western Africa. What we were looking for was anything that was in excess of 0.02 grams per ton. What we ended up intercepting was 50 grams, sorry, I wish it was 50 grams, 1.35 grams over 50 meters, which essentially from surface is an ore grade open pit intercept. So we were very happy that we intercepted that. We then followed up with RC drilling and drilled 3 meters of 21 grams per ton. So as you can see, you have regional structure, you have geophysics, you have air core, you have RC, and then you have two known highly containing gold areas, all lining up in the same area. So this is a very interesting target for us. We will be following up with more RC and eventually diamond drilling in this area, but stay tuned for updates on Lake Cowan and on the sleuth trend, of course, when we get assays back. But that is a high priority for Karora in 2022. Let's step over to SPARGOS, the new gold mine under the Karora banner that is going to be battling for some of that throughput room against those Higginsville properties. That's a drone shot from December. We are benching SPARGOS as we speak. The first few benches, of course, we're not into the meat of the ore body, so they're not right up at the grade, the average resource grade, but we'll be getting into those this year. This open pit resource right here is about 150,000 ounces as it stands today, at about 3.2 blended grade. What's key to notice here is that is just approximately the top 150 meters of the ore body. We are going to be drilling to expand that resource, both with respect to the open pit resource along strike, but also there's some very, very interesting, as you can see based on this heat map, underground mining potential at SPARGOS. We have some phenomenal drill results that we put out over the last year or so, an ounce per ton over 19 meters, an ounce per ton over 15 meters that we do have to follow up on. What you get at SPARGOS are these high grade plunging chutes that are basically stacked that extend for hundreds of meters down plunge and hundreds of meters below surface. So SPARGOS is going to be around for quite a while to come. After we exhaust the open pit mining, we will be putting an adit in the bottom of the open pit and heading underground at SPARGOS. And with those grades, it's going to be a very interesting source of feed for us for a significant. Happy to have acquired that for just $4 million in cash, plus about $2.5 million in additional milestone payments last year, or I should say in 2020, has proved to be a prudent acquisition for us. So as we grow into 200,000 ounces a year, where do we see the company moving? We just recently crossed the $1 billion market cap threshold. Very excited to announce also that we've been added to the GDXJ index, which is a huge step for Karora and its shareholders. That rebalance will be happening towards the end of this week. The announcement was made on Friday, so very excited about that. But there is a lot of room left to grow. When you look at the average market cap of the 200,000 ounce a year producer group, it's about $1.5 billion. It's a 50% upside to where we are today. And as we continue to execute on our plan, we would certainly expect to continue that re-rate, both on a NAV accretion basis, but also on a PNAV multiple expansion basis. Wrapping up here, just an overview of our shareholders and our analyst coverage. We did finish the year with a very strong $91 million. We updated the market on our financial performance in 2021 just this morning. Met all the targets for 2021, which was excellent. Very strong performance financially as well as operationally, despite all those challenges that we encountered last year. Those challenges continue into this year, which is one of the reasons why we did recalibrate that guidance. Shareholder base continues to grow, some very, very strong institutions, several of which who have been buying off the back of our strong ESG initiative. So hopefully that continues. We're very proud of that. Great analyst coverage. You'll notice a lot of their price targets now are below where the current share price is. That is predominantly due to price decks. We've seen a strong shift in the entire market, so I'd expect a lot of those targets to move as well. And up and to the right is the direction we've gone and the direction we intend to continue going. Been one of the best performance junior gold stocks out there, especially when it comes to the producer sphere. So we hope to continue that success. And with that, I'll stop talking for a bit and I'll take some questions.
Great, thank you so much. We have a bunch of questions here, so let's jump right into the Q&A. And if you do have a question, feel free to submit them now. But Oliver, in your recent nickel production guidance, you mentioned an assumption of $16,000 US per ton. At prices almost triple that level, would it mean triple the byproduct credit, or are they additional costs at higher prices?
No, it's a good question. So we do have a pretty fixed cost basis for mining the nickel. So obviously we're going to be leveraging existing infrastructure, but nevertheless there are mining costs associated with it. There's haulage costs up to surface. And then, of course, as we've mentioned previously, BHP buys our nickel stockpiles right from surface and then takes it to their facilities. They are going to be restarting their Kambalda facility in the next several months here, which is a lot closer than their other facilities. So costs will be even lower associated with that. So, but it is a fixed cost basis. Obviously, we're seeing some input cost pressures across the sector, not the least associated with diesel, of course. But as those metal prices increase, you would actually get a bit of a leveraged margin effect. So what you would end up seeing is not necessarily a linear effect on byproduct credits, but since that fixed cost basis ends up being flat right across, right across the spectrum, you'd actually see a bit of a leverage return. So it does improve obviously as prices get higher. LME has been halted for a while now, around north of the $40,000 a ton mark. But nevertheless, we're very excited given the fact that we budgeted $16,000 a ton, and the prices are significantly higher now. So yeah, good question though.
Great, thank you. And are production cost significantly levered to the rising oil prices?
Yeah, so we are a on-site generating company. So what that means is at Higginsville, we have a series of diesel power generators, basically power generation on site, which does consume a large component of diesel. On our call this morning, our quarterly conference call, Graham mentioned we consume about 15 to 20 million liters of diesel per year. That is a significant amount of diesel. As part of our entire ESG objective associated with that long-term emissions reduction plan I talked about, not the least of which, of course, is improving our cost performance. We are evaluating a number of alternative power solutions. We're looking at potentially connecting to grid power. We're looking at LNG and renewable hybrid solutions. So that work is ongoing right now. About 20% of our processing cost is associated with that diesel power generation. So we do have exposure to the diesel price. So as diesel price increases, it does impact our bottom line. As I said, as we roll into some of that work over the course of this year, we'll be looking at ways of reducing our exposure to diesel prices and also reducing our emissions. So they kind of go hand in hand. This is certainly a perfect example of a time that's very good to look at it, and that's why we're already underway with that work.
Great, thank you. How soon do you expect to see a positive impact from the easing of the border restrictions on travel in Western Australia?
Yeah, so I guess we're 11 days removed. I guess 12 days if you're in Australia, removed from the opening of the Western Australian border. Now, of course, not sort of talking about COVID-19 for too long here, but Western Australia is going through a bit of a tough phase right now as infection rates increase there. They were pretty well isolated from the rest of the country, but once they get through that phase, we'd imagine that there'll be a little bit more normalization of cross-border travel and of course labor within the state. So it's not going to happen instantaneously. It will be over the course of this year, but this will be measured in months, not weeks. But as we start to see some of those improvements, we'll certainly communicate them to the market. Unfortunately, obviously, one of the impacts that won't change overnight are global supply chains. What's happening with in the Ukraine is impacting a lot of different parts of the world, and certainly the legacy of the COVID impacts is impacting a lot of part of the world. We're seeing that with respect to ordering long lead time items, consumables from mine sites. So we're optimistic, but we won't see everything offset by that border opening.
Right. Thank you. So what are some of the operational drivers for expecting higher production and lower costs in the second half of 2022?
Yeah, so we will be back half weighted. So the first 2 quarters of this year, similar to last year, will be slightly lower in terms of ounce output and slightly higher in terms of costs. Obviously targeting that guided range by the end of the year, and we are on track to deliver that. With respect to where the improvement comes in the second half, one of the more significant components of that is just simply being into higher grade areas of our ore bodies. As I mentioned, SPARGOS is still in the upper few benches of the ore body. We're not really into the meat of that +3 gram material just yet. Expect that to improve over the course of the year. At Beta Hunt, we'll be into more of some of the higher grade zones in A zone as we move through over the course of the year, I should say. We are taking those stopes in sequence based on geotechnics, as we always have. And so we'll be into some higher grade areas there as well. So that's the predominant driver of it as we move forward through the year.
Great, thank you so much. Stan's asking, do you expect Karora to be listed on the GDX in the near future?
Yeah. So that announcement came out on Friday, which is great. We met the inclusion threshold, which is US $750 million market cap. We just snuck over that, which is a huge step for the company. We meet the daily trading volume requirement, both in terms of number of shares traded and in terms of dollar quantity traded. So that is a big graduation for Karora, as was inclusion on the GDXJ originally. So we will expect a bit of a rebalance over the course of the week. And of course, that brings you into the lens of new investors. So we'll be graduating to that next tier of investors as well.
Great. Michael's asking, will Karora be looking to add another mill in the vicinity?
So as we arrive in 2024, we will still be mill constrained. So even at that 2.5 million ton per annum threshold, we have far more feed than we can fit through a single mill. Now, we are heads down focused on this growth plan right now, particularly given the challenges associated with the labor market and associated with the impacts of supply chain on ordering items. We cannot drop the ball on our growth plan. So we will be executing that over the next 2 years and making sure that we do not skip a beat in terms of delivering that. At the same time, part of our initiative here is to canvass all opportunities in the region. We are aware of several mills in the region. We're aware of several sites where one could be constructed as well, but we have not come close to anything at this point in time. It's certainly something we'll keep our eye open for, but it's not a near-term event. We must make sure that we execute on this growth plan first, and we'll address something like that further down the road.
Great, thank you. So your exploration guidance is it's around 21 to 24 million Australian dollars for 2022. How much of that is for true exploration versus resource definition drilling? And is it possible that you would increase or decrease the budget depending on success?
Yeah, for sure. So I'll answer the first part. It's about 50-50. As sort of outlined before, there's about 10 million bucks going into true exploration across both properties, and about 10 million bucks going to resource definition across both properties. With respect to success being the determinant of increased budgets, not only is it the determinant of an increased budget, it's the determinant of continuing to drill on a target. So it's very important that and this is one of the challenges that you deal with delayed, or significantly delayed assay turnaround times, is when you drill an area, what you want to do is you want to get the assays back for those drill holes and then continue to drill more in that area. If you don't have those assays back in time, or if it takes 7 to 9 weeks, it can be very challenging to make the decision to continue drilling. So what you end up doing is remobilizing that drill somewhere else, drilling over there, and then coming back to that area once you have the assays, which obviously increases your overall cost. What we want to do is we want to make sure that we're not drilling blind. So success will determine the continuation of each target that we drill. And then we also, we're in the enviable position with our operational cash flow generation that depending on success, we also have the flexibility to increase drilling budgets. In fact, we did do that last year. We increased drilling budget just slightly in one area as we were having some great success there. We weren't able to drill out that entire budget as we couldn't just simply complete those meters in time before the end of the year. But it is a perfect example how based on success, we have the ability to increase the budget.
Great. Thank you. Terrence is asking, what metal pricing are you using for planning purposes?
Yep. So our reserves are done at $1,400 an ounce US. So that's our reserve price. And as we previously mentioned, we use $16,000 per ton US for nickel.
Got it. Thank you. So what are some of the key milestones to look out for on the growth plan to 200,000 ounces in terms of ramp development at Beta Hunt and long lead items for the mill?
Okay. Yeah, so for the ramp, we've started it from both directions. We started it from underground with our own crew, so that's already underway. And we started it, I made this joke on another call, we're romantics. We started on February 14th with our contractors from surface. So they're starting from surface and they will both meet in the middle. So that's on track. With respect to, and that's on track for completion before the end of the year. With respect to the mill expansion, we will be placing our long lead time orders probably within the next month or two, and that's predominantly for our SAG mill, which is slated for arrival in the first half of next year, and then we'll begin the expansion work on the mill in earnest. The additional work around that is well on track and on schedule, and we're actually just completing our value or advanced engineering phase of the mill expansion. So everything's on track and on budget.
Great, thank you. In closing, we're just gonna, there's a question here just clarifying something. John's asking, did Graham say on the call today that Karora spends 50 million Australian dollars on diesel annually? And was that before the recent jump in diesel prices?
Yeah, so he was talking about consumption in liters. He was talking about the 15 to 20 million that we consume. Which based on the fluctuation in diesel prices would be fairly similar in terms of actual dollars spent, because the price is over $1. But yeah, that would be the range.
Great. Well, thank you so much, Oliver, for taking your time to go through the presentation today and the Q&A. And of course, also thank you for everyone who submitted questions and joined us today. If you do think of another question, or if we didn't get to your question, we will make sure that those are emailed to Karora and you can they'll follow up with you directly. But if you do think of another question, feel free to email Karora Resources. Their information is on the slide here. You can also go to their website for more information, karoraresources.com. And as always, this has been recorded and will be available to watch afterwards on 6.com. Before we close out, Oliver, I'll pass it back to you for any last remarks.
I think you closed it off very well. Yeah, thanks everyone for joining, and we'll see you next time. And thanks for your continued support. It's been a great run with Karora, obviously, but lots more excitement to come. We've got gold, we've got nickel, we've got lots of projects we can work on here.